Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to a small session on corridor method, under which we are going to learn how do we amortize the actuarial gains and losses that we book under US GAAP. Now, before looking at this session, I hope that the basics about pension are clear and the viewers have already gone by the overall one full example of the pension accounting. In this particular session, I'm going to specifically focus upon this corridor method. Now, before I start with, let us just recall as to what all things are being covered under something called as actuarial gains and losses. Now, you would recall that in case of the pension, defined benefit plan, there is the liability on one side and the piggy bank or the plan assets on the other. Now, the actuarial can change some of its assumptions like mortality rate, etc., because of which my PBO can go up or down. The delta in the PBO because of actuarials, change in the assumption is covered in AGL. Not only that, there is something from the asset side also which goes into AGL, which is effectively the difference between the expected return, which is one of my independent assumption, and the actual return on the plan assets. For example, if the actual return is 10%, whereas we were expecting a return of 12%, this delta of 2% of the opening plan assets is also going to go into AGL. All that we have learned while we have been discussing the calculation of PBO and the calculation of plan asset, and we have been categorically saying that it's more a matter of valuation than a matter of accounting. So the calculation under IFRS and US GAAP is absolutely same. But what is difference is that with this calculation, you are going to get some number, let us say, a hypothetical number of $4,000. The accounting for this $4,000 is different under US GAAP and IFRS. My IFRS says that $4,000 should be parked into OCI and should remain in OCI forever. However, my US GAAP says that initially the amount should be parked into OCI. There is no doubt about it. However, we need to amortize this amount back into income statement over the average service life of the employee. Okay, now let's just see how to apply this corridor method. I have a full example which is waiting for you, but let's just look at the rules very quickly. What we are saying is that at every point in time, whenever you need to amortize any AGL for that particular year, look at the opening balances of the liability and the assets. The higher of the two, take 10% of that, and that becomes the acceptable range, the materiality limit up to which no amortization is really required. So it's effectively what I tell my students is that this is the 10% of higher of the two, the PBO or the plan assets. Let us say there is a hypothetical number, we can take it like, let's say $2,800. Okay, this $2,800 is the maximum range which can stay in OCI without any amortization, which you and I know as dirty surplus accounting. So this really the materiality limit, the extent to which dirty surplus accounting will be accepted. Anything over and above that, let's say there is $4,000, so there is a delta of 1,200 which is going to be over and above this corridor, the maximum range, and this amount is what we are saying need to be amortized over the remaining service life of the employee. Now, what is very important to note as to how to calculate this remaining service life, it will look very easy if I say that the remaining service life is 6 years, so you are going to amortize $200 each year. Now, obviously, the calculation of this 6 needs a little bit of care and meticulous observation. So I have an example here which says, let's say the employee retires at T10, he's going to live for 3 more years. So, taking all that aspects into account, there are different PBOs, that I have calculated, 8100, 8700, and so on and so forth, and the values of plan assets, at respective time zones. Now you would see that in some cases the PBO is more, and in some cases the plan assets more, obviously because both will move independently. These are matter of valuations, not a matter of accounting. There are different factors which impact PBO and independent factors which impact plan assets. So that's a bit of the base example that we are going to start with. Now in that, let us assume that up to the fourth year there was no actuarial gains or loss. So that means in this PBO there was no AGL which was lying in OCI, and the plan assets also obviously have not resulted into any kind of AGL so far. Now imagine that in the fifth year, I get a call from actuarial. Let's say the call came at the beginning of the year. Okay, so the beginning of the fifth year will also be termed as T4 itself. Now at the beginning of the year, I get a call from the actuarial, because of which this PBO has gone up by, let's say, $500. So actuarial gain and loss because of liability is 500. Now the aspect is you have to amortize this 500 over the average service life of the employee. What is critical to note here is that this call came at the beginning of the fifth year. That means effectively at T4, and from here to here there are effectively 6 years that need to pass. So while the amortization will happen over the remaining service life, remaining as in it's a futuristic thing, since this delta has happened at the beginning of the fifth year, the fifth year also will be taken into account for the purpose of remaining service life. The first amortization will start from here. So overall there are going to be 6 amortizations at T5, T6, T7, T8, T9 and T10. So the question is, what will be the amount of amortization at T5? At T5, I'm going to follow my steps, which I have kind of noted here. Note down the opening balance of PBO and, plan assets. So the opening value is 8100 and 7100. Take 10% of higher of the two. So the 10% is higher of the two is 8100, which is $810. So this becomes the maximum range up to which there is no amortization required. So I am going to look at the total opening AGL. Now imagine that fifth year is the one where we are amortizing. The amortization always happens of the opening AGL. If you look at it, the opening unrecognized AGL, which was $500 in my case, because the phone call that came to me was at the beginning of the year. So that 500 amount is still under the materiality limit, and therefore there will not be any kind of amortization done in the fifth year. So to speak, that my unamortized OCI or unamortized AGL is 500 when I look at my balance sheet in my at T5. So if I look at it, unamortized AGL at T5 is equal to 500. Now just also imagine that I get another call from the actuarial, and perhaps again in the sixth year, again at the beginning of the year. So it seems that actuarial is calling us at the beginning of each year. Remember that in fifth year there wasn't any amortization, so you also have $500 of unamortized cost with you in the tumbler. And the delta that the sixth year delta, the actuarial has again given us some bad news. It's because of which the liability for example goes up again, and this time let's say it goes up by $800, because of which the opening in the sixth year, I'm saying in sixth year, the opening unamortized becomes equal to 1300. Now there is a 1300 balance at T5. Now beginning of the sixth year is T5, and from here to here there are 5 years. So it's very simple to say the 1300 divided by 5, but you have to be very careful in the exam. The first amortization is going to happen at T6, T7, then T8, 9 and 10. So there are 5 amortizations is what I said. In the sixth year, the beginning unamortized value is 1300. Sixth year, if I have to create a tumbler, my opening balances now become 8700 and 8900. The higher of the two is 8,900. The 10% of that is 890. The total opening unamortized AGL is 1300. 1300 is a value that arose here at T5 level. So I'm looking at the accounting for the 6th year. So the opening balance is what is present at T5, which is 1300. That needs to be compared with 10% of that, so 890. So the delta of $410 is what is the excess which needs to be amortized over a period of 5 years. The first amortization being from T6. So if I look at it, $82 is the amount of amortization that will happen starting T6. So A is equal to L plus C. If I look at it, it's a loss, so I will remove it from OCI, $82, and I'm going to put that back in P&L as the amortized AGL, part of the pension expense. Okay, now what you need to understand is at T6 there was total $1,300, out of which 82 has been amortized. So 1218 is the total amount of unamortized AGL which is left at T6. So while I will enter my 7th year, a new tumbler is going to be formed up. A new tumbler which will be based on the opening values of PBO and plan assets, which is 9600, higher of the two. The 10% of that is 960. The total unamortized value is 1218. So a delta of $258, and now it will be amortized over a period of 4 years. The first amortization being starting at T7. So that divided by 4, by doing a quick maths, I get a value of $64.5, which is again the amortization into the P&L account. So 64.5 is the 7th year's amortization, which will be part of the pension expense. What students need to understand it very, very carefully is, when does the actuarial gain or loss arise in our life? Although it was part of the 5th year originally, when this original $500 had come into my life, in the 5th year the value got at the beginning of the year. That means there were entire 6 years for this value, and the difference between the time of arise and the retirement was 6 years, and therefore I had discounted, or should I say divided that amount by 6 years. It was just the matter of fact that the total amount was lower than the materiality limit, and therefore nothing got amortized in the 5th year. So that is something that you need to keep into mind. Let us now look at another example, and herein the only delta that I'm going to focus upon is the phone call in the 5th year that had come at the beginning of the year is now going to come at the end of the year. So now let's just look at it. Let's say the actuarial had called me for the same amount, but now this time the amount got into my life at the end of the 5th year, which is at T5. So I'm going to not amortize anything in the 5th year, because this 500 has arisen here, and from here there are total 5 years pending. In the 5th year the opening unrecognized value was 0, therefore there would not be any amortization in the 5th year. You would recall that the amortization was still not there in the previous example. The only thing, the difference was, a very important difference was, at least I had checked for all the steps. It was only just because of the fact that it was below the materiality limit. Had this materiality limit by chance would have been 310, then I would have amortized this delta of 210 over a period of 6 years. However, in this case, while the amount arose in my life at the end of the 5th year, the opening unrecognized amount is 0. This amount obviously will become part of the opening value for the 6th year, and it is going to be amortized, or should I say be checked for amortization for the 6th year. So in this case, where the actuarial is calling me to increase the PBO by $500 at the end of the 5th year, I will not do anything at the end of the 5th year, just that the PBO is going to go up, and that's about it. Let's come to the 6th year. In 6th year, there is some kind of an opening unamortized amount, which is this $500. And you would also recall that the actuarial had called us in the 6th year as well for a delta of 1300. Now you would have to understand that in the 6th year there are two different time zones of at the beginning and at the end. So while this 1300, which got into our life at the end of the 6th year, is not going to be included in my calculation, it will be amortized over a period of 4 years later upon. But for the period for 6th year, the opening unamortized value is 500. That we need to understand. The 10% of higher of the two at the opening level, which is 8700 on 8900, so which is, this is the higher of the two. The 10% is 890, so therefore no amortization, because the total amount of unabsorbed AGL is lower than the materiality limit. Let's come to the 7th year. Now by the beginning of the 7th year, that means I'm saying here you already had 500, because of which nothing got amortized, and there is one more amount, beg your pardon, the total amount was, I believe, 800. The call that came to me in the 2nd year was 1800 of 800, because of which the total amount was 1300. So 500 plus 800, the total amount, I'm just maintaining parity with the previous example. Now this amount got into my life at the end of the 6th year. This amount needs to be amortized over a period of 4 years, because there are 4 years still remaining. I'm going to check it for the materiality limit. Now in the 7th year, the beginning values are these. The 10% of that is 960. The delta between the two is 340. This needs to be amortized over a period of 4 years, starting from T7, T8, T9, and then T10. So while we are in a particular year, let's say the 7th year, you will look at the opening unrecognized amount, which is 1300 in this case, looking at the same time zones PBO and plan assets, which is 9600, 9400, and the amortization is going to start from the end of that year. So here it is $85, and the accounting entry is going to be similar, that OCI is going to go up since it's a loss, and the P&L is going to go down. So by the end of the 7th year, which is nothing but T7, there was 800 plus 1300 plus 500 minus 85. So overall, if I look at it, there is an unamortized value of $1,215 while I enter the 8th year. While I would enter the 8th year, let's do that also very quickly. The unamortized opening balance is 1215. The opening, the materiality limit is 995, higher of the two. So 220 is the delta. This amount is here, and there is a life gap of 3 years, $73.33 just by doing an oral maths, and this is the amount that needs to be amortized, 73.33. So overall, the amortization in this 8th year is equal to this. So therefore at T8, the total value of unamortized will be equal to 1141.67. So that's how we are going to look at each year. Each year the materiality limit is going to be dynamic. What we call it as a tumbler thing is can be construed as this materiality limit. Obviously it's more to make the example understandable. So I hope that this particular session was useful. I look forward to speak to you on my other tutorials on pensions and other aspects very soon. Thank you very much. Greetings from FinStudy Club.